Thanks for tuning into the first talking point of 2023. I'm your host, Neeraj Shah. I'm borrowing a few lines from our guest today. The macro is transitioning from reflation in 2020-21 to inflation in 2022 to a slowdown or a potential slowdown in 2023. So some would argue it's not a potential slowdown, it's already here. Since no amount of study or research can ever bring an investor near to what really happens when it comes to investing, let's put the spotlight, therefore, on someone who's been there and done that, which is our guest today, Maneesh Dangi of Mosaic. And let's try and understand how is he approaching 2023 as a macro investor on the first talking point of the year. Maneesh, great having you. Thanks for joining in. Hope all is well and a happy 2023 to you.
All well, Neeraj, and Happy New Year to you and all your viewers.
Thank you so much. So, Maneesh, how do you view India in the current world scenario when the West is arguably slowing down? India, from its heady levels, is indeed slowing down, but looking okay relative to the world, and a China which is going to open up, but one doesn't know quite what it will do.
Absolutely, Neeraj. So India is sort of entering in a relatively modest 5-6% growth lane, so to say. The macro for India is sort of somewhat healed because the peak financial stress is behind. And the current account deficit of India, of course, has also would be like near halving of sorts in next 3 or 6 months. All of that augur well for India's macro at margin, but the past pain would actually continue to hurt India's growth at margin, and therefore, as you said, from the heady, assumed 7-8% growth regime, we're most probably entering in 5-6%. But to take a sort of step back, as you sort of narrated, that the policy transition in the world, Neeraj, from reflation to 2022's restrictive regime, where all monetary policy authorities actually tighten rates, we are actually entering in a setup which otherwise, in a normal reflex, if central banks and fiscal authorities had, given the slowdown, ideally in 2023, pretty early, in a counterfactual world, you would have had an easy policy. But because inflation scars are so deep, especially in West and more specifically in US, is that there'll be an inertia. And so the reflex of actually cutting rates and easing policies would be missing. And thereby, I think the dominant narrative, which, as you alluded to, that, slowdown is already here, the narrative for markets would be deeper slowdown, perhaps, and more importantly, the dry up of liquidity pretty much across the world. So, while, as we say that the macro is healed in India, the past scars are still there, and therefore the growth run rate will slow. But given the tightness of liquidity and the global growth slowdown actually accelerating, it's very likely that India's growth outcome would not be sort of pretty good. So to that extent, there'll be a slower growth than what is widely anticipated in India in 2023.
Manish, since you have the ability and the luxury of trading different markets and different asset classes, how do you look at equities as an investment in general, and of course percolate it down for us from an Indian equity perspective as well, vis-a-vis all the other options available to you? I mean, Howard Marks in his note wrote about this sea change. You and I have spoken about this, that the TINA factor is probably long gone for equities. So how do you look at all the other asset classes and all the other, not just from an Indian perspective, but from a global perspective? And where do you place India and Indian equities within that?
So Neeraj, sort of to assess in any asset class relative value, you ought to look at its in the spectrum of what you call various ways of looking at valuation of an asset, versus other, So India could be compared with its historic valuations, and you would argue that, I would anticipate about 950 odd buck of Nifty earnings, and therefore India is trading at the moment at 19.5 or 19 times odd. So pre-COVID, we were at 18 odd times, and to that extent, we are slightly expensive. Incidentally, India remains the only country, outside of China maybe, which is actually more expensive to forward PEs than pre-COVID level. Even to the sort of longish history, India is about 5-10% expensive to the forward earnings. So from a historical standpoint, India does not look obscenely expensive, as it wasn't last year also when we discussed, but it is not cheap. Second way to look at, of course, as I said, that other markets, more specifically US, is starting to look relatively cheaper. Bear in mind that US also delivers somewhat similar ROEs, and its growth has been actually sort of higher than India. I mean, earning growth has been higher than India, especially in the Northeast, in the decade of 2010. Sorry, and so to that extent, US is actually attractively placed. Once you sort of start to look at other assets, more specifically bonds, you begin to realize that even in US, where US equity, as I said, is actually relatively cheaper, but US bonds are actually cheaper than US equity. You can actually get 4.5% on 2-year US. And bear in mind that US's inflation will be only 2% or thereabouts for next 2.5 years. So to that extent, US bonds are giving you 2% real. So it's a hell of a good deal, especially in the context of last 5-10 years have been, near zero real returns, or at times actually negative returns, real returns, I mean. Even in India, Indian equities are relative to bonds, would actually deliver about 3% equity risk premium. Now, investors who are spoiled for the risk premium of 5 or 7%, over last 10-20 years, because that's what you've experienced, versus bonds you've earned 5% since 2012, and since 2002-3 you earned about 9-10%. They would be disappointed, given this 3% risk premium. So if you remember, Neeraj, last year also we had the same argument that while markets are not exorbitantly expensive, but the risk premium available to in the equity market is relatively low, then actually bond yields were at 6%. Now bond yields actually have risen to 7.5%. Your fixed deposits are actually yielding you 8.5%. And to that extent, risk premium in India has actually shrunk in last 1 year instead of having widened, even though valuations are actually cheaper. Okay, so this is the broad, space to scan in terms of valuations versus bonds and equities. And to that extent, I think, if I were to dial risk, Neeraj, I think the best asset class will be US bonds, then US equities, then Indian, 3-year accrual bonds. We can talk about credit if you wish, but that's also pretty juicy. And then then Indian Nifty, small cap and mid cap. I'm afraid we can talk about various issues with them, but they are still looking fragile to me and sort of avoidable at margin. So from an asset allocation point of view, it's sort of a decent time to Neeraj, allocate to the outside world, more specifically US. I'm actually starting to look really attractive. And within India, I know it makes sense to be somewhat overweight, accrual, which is 2-3-year bonds at 8-9%, than equities.
So Manish, would you reckon that this could be how a global investor might think as well, and therefore it might well be that while we did have a bit of a recovery from the abysmally large FI outflow number that we had in 2022, that 2023 could yet be a listless year of sorts from a foreign fund flow perspective, because they, like you are pointing out, might find the outside world, particularly the US market, the mother of all markets, a lot more attractive, both on the equity and the fixed income side.
Bingo. I mean, absolutely, nothing else can be added to it, apart from a small point that I like to sort of, share with a lot of investors in India, that look, large amount of foreign flows from a structural standpoint emanates from a small group of people, which is 45 plus, 45 to 65-year-old oldies in developed markets. And that group, as a population, has peaked. Okay, And therefore, over next 5, 10, 20 years, in terms of sheer size, that group will be shrinking, 45 to 65, because Western societies are aging, but 65 plus are actually, the group is actually growing much faster. And so to that extent, the net flows in India and many non-OECD countries would be trickling only. And so relative to history, when FIIs actually dominated local, buying, I think, FII's role would actually at margin will be somewhat insignificant. Again, observe this over last 5, 7 years data, FIIs actually have been just about 0.25% of market cap. Typically they tended to be about 1.5% of market cap in the previous, 10, 15 years of sort. Back in 2007, FIs were actually buying to the extent of near 3% of, India's market cap. So in a sense, the Indian markets have grown, but also more importantly, structurally, the cohort which was actually putting money in emerging markets and many other markets or equity at large actually is going to be shrinking now. It's not growing anymore. So to that extent, structurally also FIs would actually not be a very, very significant force to reckon with. But cyclically, I agree with you that given that there's going to be an alternative for a lot of passives in terms of US yields, I am afraid, more money would actually move to US bonds than US equities, and more money will actually go to US equities versus, emerging markets. So contrary to the popular narrative that it could be a very well a year of emerging market, it could well be a year of actually flows back to US, or rather further flows to US in some form or other, be it bond or equity.
Now, before I talk about Indian credit, Manish, just juxtapose this with the kind of FDI interest that India is drawing. And we've seen multiple announcements already. When I speak to brokers who cater to global clients, they talk about the possibility of 2023 being a landmark year of companies moving their manufacturing bases to India. And we've seen evidence of that. I've personally spoken to a few companies, and we might continue to see that. Now, if that were to happen, I'm not saying it's a certainty, but if it were to happen because of China plus one, Europe plus one, so on, so forth, how does that contrast work? That India will see potentially fairly strong manufacturing setups and FDI flows, but not necessarily FII flows because they might move to the West.
So Neeraj, I mean, we all will be cheering it in to the extent that, finally it sort of appears to be a moment for India yet again, let's say that we missed many times in the past. And if we actually can pull it off, it could very well be, that our kids would actually, relish perhaps, one of the sort of finest and best economy in the world. But, you ought to sort of take care of this fact that last few years, all the cheering for FDI, once you sort of begin to look at numbers, needle hasn't moved much. We still on a net basis, there is a gross FDI, but there's also a lot of dividend that we pay to the firms who had invested in India in the past, and a lot of external FDI, which Indian firms are actually buying abroad. On a net basis, it's still about $40 billion. For a $3.5 trillion economy, a $40 billion is a very, very small, sort of, it's a small chip, so to say. And to that extent, for risk taking, for manufacturing boom or for growth recovery, it is an important part, Neeraj, for a sector, let's say, in some chemical industry or some let's say, new industries that we talk about, of iPhones and whatnot.
PLI led, yeah, sure.
But for in aggregate for the economy, I'm afraid, it's not very significant. Remember that, we're about 1.5% as a percent of GDP. In boom years of China, in 90s, it used to be sort of a heavy 4-5%. Okay, so that and Eastern Asian economy thrived during 80s and 90s, in a big way because of FDIs. That's no more the case. FDIs as a percent of world GDP as it is has been shrinking. And in India's case, of course, the boom years were again noughties, not 2010s.
Got it. Okay. No, fair point. And I'm glad you put out that caution out there. It's important to look at the aggregates as well and not just individual announcements. So thanks for that, Manish. Now, a point to credit. You mentioned the preference rates, US bonds, then equities, then from an India perspective. Before India equities, the Indian credit, Indian bonds. Tell us a bit about it. Obviously, the rates are looking attractive, but a lot of narrative out there about how we are peak inflation and therefore peak rates as well. Maybe one or two hikes and then the calibration or the loosening begins. What are your thoughts here?
Yeah, so on there are a couple of things here, Neeraj. I talked about the dominant narrative in India and abroad would be slowdown, but alongside there'll be a additional market narrative of liquidity drawdowns or withdrawals. Okay, it's important to sort of keep this in mind that India's liquidity dry up has been one of the fastest in the world. In a sense, at some point in time in 2021, when we were floating in liquidity, it was near 4% excess liquidity in the market, which is banking system as a percentage of overall deposits. Okay, remember those days of 7-8 lakh crores of excess liquidity sloshing around in the system. That number is actually right now negative. And so to the extent what Fed is trying to achieve, at a peak liquidity withdrawal level, India has been able to achieve already, not because of RBI's activism, but because of large current account deficit and BOP deficit, which led to a drawdown on our reserves, and therefore Indian INR liquidity in the banking system has dried up. So one ought to keep in mind that liquidity actually in India is a bigger force than rate in itself. So repo rate, of course, matter, but then for the large part of credit complex, where you and I sort of really operate in, borrow, lend, what matters is actually how much banking system liquidity is there, and that actually has dried up very, very significantly to the extent, Neeraj, that if you talk to some people in money market, you would realize this that it is pretty much looking like 2018 right now, or in fact staring at rather worse situation. To a certain extent, something similar is going to happen in US also, where $95 billion run rate on a monthly basis of withdrawal will happen, that Fed would do in terms of QT. So that's the dominant narrative that, while rate hikes in world, both US and India, would slow at margin, but liquidity will continue to actually leak. And that will continue to put pressure, aside from the fact that, the past tightening would also begin to sort of make an impact, So, markets will actually do the job of actually pricing future, but the real, because you asked me about credit, credit actually does not respond to future, but it actually responds to like commodities to here and now. And then the liquidity is so tight, suddenly, market is having to price, folks who are otherwise credit worthy at significantly higher yield, which is what has happened in India as well. So, which is why I made an argument that, it's a case to make that in Indian credit has had sort of pretty rough quarter, and it's going to get rougher in next 3 months, not because of what you call banking lending standards are tightening, nor because their balance sheets are weak. It just, in the firm's balance sheets are actually pretty squeaky clean, so to say, one of the best since 2007. And yet, actually, repricing has happened because of the lack of liquidity, so to say. And that gives an opportunity to investors like us, that in AA papers, in India, which are actually from a pure credit standpoint, are actually better placed than what AA pluses were there in 2018. And yet they're offering significant levels, So you can create a portfolio of 9.5%, 10%, Neeraj, of AA plus, or, a mix of securities today, given what the liquidity setup is, and which is pretty clean deal, for 2-3 years, if you get 9.5%, 10%, you're not going to get much more than that in equity. As I argued that equity risk premium for you is just about 3.5% of ROIs and dividend distribution and sort. So I think short end is as such juicy. Your dad could look for some small finance bank, would offer you 9% right now. PNB is offering you 8.25 for 1.5 year bonds. And then, if you have an active access to, bond markets, as I said, you can acquire some bonds in AA space at 9.5, 10%. So it's a good time, and which is why your original point that this TINA thing is for sure not there now. There are many, many opportunities to build portfolios.
Wow. Manish, in which case, tell me, I heard you mention that small caps are probably the last in the pecking order. So what, 2022 is a year, small caps underperform large caps by about 5-6%. When I look at it from the lows of June, small caps actually outperform the Nifty by a similar percentage, about 6%. So, but aggregate small caps have underperformed. There's a lot of talk about how the Nifty may consolidate, but the broader markets, individual stocks may do their own thing, and therefore the place to be is in smart mid caps and small caps. My question to you is, are you in that camp, or are you, because you're a macro investor, kind of shying away from the aggregate small cap, mid cap space? And if you are into equities, you're parking yourself in the large caps.
Yeah, so let's just look at two sides of small mid caps. One is the balance sheet themselves. They tend to suffer, Neeraj, when liquidity is tight and access to finance or capital is somewhat restricted. And to that extent, these firms have had sort of gather time over the last 2-3 years, especially after 2020. And the water is receding now, and the capital access to them for last few months and incrementally for next many months would be somewhat restrictive. Second is, of course, that they also have lower pricing power, so to say, and to that extent, if the growth run rate, and more specifically, remember, Neeraj, that the nominal growth, which is clocking at about 15-20% right now, is going to halve most probably in next 1 year. So in that setup, actually, small caps tend to suffer. Low inflation for small cap is a sort of a disaster. Good high inflation, actually, small caps, because they tend to operate in a lot of intermediate sectors, they actually benefit from it. So that's the fundamentals of it. I also worry about the flow part of it. So in a sense, look at mutual funds. A large part of money flow to mutual funds has been to small and mid cap. Every month about 1.5% of AUM of mutual fund accretion is happening in small caps. Now, because as we talked about the absence of TINA, a lot of HNI and a lot of retail investors will have an opportunity to go to rates. And to that extent, a 2018-19 flip can play out, Neeraj, in which, in 2019, FY19, when the rates tightened, the MF flows, ex-ETF, actually halved from FY18. So my worry is that MF flows will actually slow. Cyclically, FIs will not be big sellers, given they will not be a big, significant force, but they'll not be big sellers. To that extent, and HNIs will be sort of relatively missing because of the other opportunity, because the TINA is not there. So to that extent, the overall flows could still be about 0.8, 0.9% or 0.7% of GDP, but the flair and the shape of the flows will be different, more dedicated towards what you call large cap, because a lot of small cap investors, the retail ones, will find other opportunities. So my sense is that the overall aggregate flows for small cap will actually dwindle, to a certain extent what happened in FY19. So both on the fundamentals and flow side, our old argument of last 1 year that, once you enter in a weak macro, stay away from small cap. They may give you upar niche, but net outcome, through the cycle will be bad for you. And therefore, if you want to be in equities, hide yourself in large cap only. Small and mid cap, you will see both balance sheets struggling, as well as, flow side of it actually starting to sort of wobble.
Okay. Manish, my final question, and that is also wanting to understand from you, how would the contrast, and in my mind, the contrast that exists, play out? Most people peg the growth for the next year to be subdued, but the growth for year after that to be pretty strong. And now, with an assumption that earnings growth will follow the same pattern, and we have a relatively stronger growth after the 950,000 rupees EPS, whatever it comes out to be in the next year. If we have a strong earnings growth, let's assume that's the assumption of the hypothesis. But at the same time, an observation that you made on your LinkedIn yesterday about the falling ROEs of India. Now, Indian valuation multiples have also in part held up relative to the rest of the world and rest of the EM and the Asian Pac because of the superior ROE profile. If that is into question mark, could we have a case of higher earnings growth? Yes, but lower multiples, and therefore might kind of negate the absolute upside that might come into markets, equity markets, even if there was earnings growth.
So Neeraj, it's an interesting thing, when I looked at last 30, 35 years of leverage in Indian corporates, they've been trending down. Of course, for the reasons that, every decade, it basically, especially after 1990, because of increased macroeconomic volatility, it flushed out high levered players. And to that extent, of course, the consensus today is leverage is bad. But its after effect, of course, is that once you reduce the leverage, to that extent, it actually hurts ROEs because, high leverage, relatively high leverage, not very, very high, but high leverage actually aid ROEs because, at margin WACC comes down. Now, some of the a rather large part of ROE decrease over last decade, you can attribute to purely decrease in leverage. Okay, so that's sort of a one point. But I think a more interesting point is that India's sort of exceptionalism of sorts, during 2000s, and one would argue that even 90s, that Indian corporates actually used to deliver significantly higher ROEs than rest of the world, and more specifically US, given that we sort of bother more about that market. During 2003, 7, these boom years, which we all fondly remember and wanted to come back ever and ever again, India's ROEs were about 10% higher than US. Okay, that number has converged actually to a certain extent that after 2017-18, US ROEs were actually higher. So, in some sense, one strategist and a fund manager has to sort of look back and think that is it so that, the past exceptional high ROEs of Indian were to do with something unique to India then, which is low competition, high leverage, and whatever regulatory setup that we had then, and market wasn't open to the international competition and so on and so forth. And if that has changed for good now, as far as we are concerned as consumers, it's likely that Indian ROEs sort of are going to be settling at 14-15%.
So does that have an impact on multiples?
So, which actually, when you put a simple ERP calculations, equity risk premium calculations at 14, 15, or rather at 16% of ROE and 30% dividend distribution growing to 40% in next 10 years, and then, terminal growth of, risk-free rate plus 50 basis points, so let's say 8%, you will get, 10.5% or 10% return. So, this whole thing that, somehow you would be able to extract 15, 18% from Indian equities, very difficult, unless there's something exceptional begins to happen in terms of India's growth acceleration, oil cools off dramatically, and people shut down to China and India pivots to West completely. All of that is possible, but, as and when it happens, we will see. Right now, doesn't look like. The good news for all of us on a fast and happy New Year note is that there is an alternative. You don't need to be in cash anymore. You can get 8-10%. You ought to be not out of equities, of course, and some allocation, but be a little bit underweight. Instead of 60% equities, if you used to be, let's say time to be 50, and add that extra 10% either to US tech, which is actually looking sort of pretty cheap, or Indian bonds, especially the 3-year corporate bonds and corporate bond fund, short-term bond funds. And it is an opportunity, Neeraj, on this first day, it's an opportunity that very few times it so happened over last decade that you looked at US with awe, but you always found that it's run up so well that how on earth you would sort of buy. And then when it fell, India also fell, and to that extent there was an opportunity in India as well. isn't it? But today there is an opportunity which is unique in some sense that US offers that opportunity because it's relatively cheap and could stay cheap for the next 6 months. So it's time for you to dial global risk and sort of rebalance portfolios away from just home bias that one tends to have in India.
Lovely talking to you, Maneesh, as always, and more so on the first day of this year. Thank you for that advice and thank you for talking to us today.
My pleasure.
And viewers, thanks for tuning in to Talking Point.